First, yesterday we learned that consumer confidence took a plunge to a 7-month low, with pessimists outnumbering optimists. As Rove used to ponder, what the... And even more insightful, I guess, would be Franklin D. Roosevelt's famous line when he said, "The only thing to fear is fear itself." In case you missed it, you probably didn't, because the media outlets out there always lead with bad news. The Westpac consumer sentiment reading fell 4% to 95.1. This is the second month in a row with this happiness index under 100, which is not good news for the economy and the PM. This really puts pressure on Treasurer Scott Morrison with his budget, which better not spook consumers more, or we might be looking at a new Prime Minister, Bill Shorten, on July 2. By the way, in case you missed it, you possibly did, because the media tends to ignore good news. Business conditions came in at an 8-year high on Tuesday, and business confidence spiked from a good 3.4 to a strong 6.1. So business is comfortable with the economy and the PM, but not the consumer. OK, let's try to work out why the consumer might be negative. Try these bananas. The banks have taken it on themselves to do out-of-cycle interest rate rises. I guess on APRA's and the government's encouragement, investors buying property were hit with higher interest rates and rationed out loans. The stock market has had a shocker of a start to the year. A pommy economist warned of a housing collapse that would cripple our banks, and the media went along for the ride. Short sellers have been short-selling our banks and trash-talking their balance sheets, and yes, the media has gone along for the ride. Super fund returns have fallen, partly because of bank share prices, and Bill Shorten wants a royal commission to banks, and the media, of course, went along for the ride. House prices are slowing, and the media loves to tell us that a price crunch for Sydney and Melbourne is just around the corner, and yep, the media loves that ride in particular. Arium, Dick Smith and Slater and Gordon have failed recently with actual or pending job losses, and didn't the media get plenty of exposure on that one, with Bloomberg quoting experts, in inverted commas, who said our banks will face a Congo queue of failed businesses and bad debts. And on top of all of this, the great grey hope, Malcolm Turnbull, has been performing like a prize fighter with rubbery legs. Apart from talking about good stuff on innovation, that the normal consumer can only guess what it means. Maybe it's, you have to hope it's not, what's that, robot? Will it take my job? He and his team, Malcolm and his team, have come up with a GST increase and state taxes that could be increasing, and states could actually levy the taxes. Today's great unemployment news shows Aussie consumers are over-influenced by excessively negative media in the 24/7 news service world. So they're missing the more rosy reality often talked about on this program. And that's what we're going to talk about right now. How are you, mate?
I'm well, Peter.
What do you reckon? Do you think the media is scaring the pants off consumers?
Well, first of all, mate, I feel like H.G. Nelson after Roy Slaven's just delivered an epic spray. But yeah,
what a spray!
I am on board with it. Now, you know, there's philosophy around media, and I love the media. I work in the thing, but they just sometimes pick on the bad stuff all the time. Well, the purpose of media, according to Noam Chomsky, that famous philosopher, is to confirm the prejudices of its consumers. So if media are selling stories like that, it tells us how investors generally are thinking. It doesn't make it any better. Yeah. But that's the reality of it at the moment, Peter. The effects of the GFC were so scarring that people are focused far too much on potential risks.
I know Charlie Aiken said in a speech a couple of weeks ago, I heard him speaking, he said, you know, if you're a doomsday merchant, you're a sage. If you're talking the market up, and the fact that the market rises 8 out of 10 years, that in more years it goes up and it goes down, but you're still a sage when you talk the doomsday tool.
And it doesn't matter if you've got 8 of the last 10 years wrong. The 1 year you're right, you'll be celebrating.
Genius, yeah. He called it. He called it. All right, so it's been a great 3 days in a row. What's behind it?
The key factor here is that China trade data. One of the big worries for some years now, and for the first quarter of this year especially, was worries about growth in China. Yep. Now, despite the fact that there has been a steady drifting of growth down from above 10% to the current rate between 6.5% and 7%, and the economy has managed that massive adjustment without any disruption, really, market pundits are still calling for the end of the Chinese world. It doesn't look likely to me, and that trade data we saw this week directly contradicted that story that it was all coming in the first quarter of this year, because exports grew by a whopping double-digit percentage gain. Now, that just goes directly against that story. Not only does it confound that story, but all those people who doubt the good numbers that come out of China couldn't doubt this one because exports and imports are verifiable. There's a partner on the other end of it. So we can check these numbers. There's no doubt that growth was delivered in the Chinese economy. That changes everything.
Okay.
That changes commodities. That changes currencies and it changes the Australian share market.
So you're saying that the better Chinese data gives a bit of foundation or a safety net to the rises in oil prices and iron ore prices?
Absolutely. It's not just better, Peter. It's a punch in the face to the China bears. This directly.
It's an eat my shorts moment for those sons of bitches, to put it crudely.
It made them look like idiots, to be frank. It made them look like idiots.
And look, sure, they're entitled to bet against the market, but it really has rocked a lot of people's wealth aspirations and all that sort of stuff.
What concerns me, Peter, is the way we get rid of one concern and immediately they raise a new one, because that's the job. That's not helping investors.
Here's a good question. How come Peabody was accepted and ignored? Because it was a big company and it's gone into Chapter 11. Why didn't it have the same impact as, say, Glencore?
Interesting one, isn't it? First of all, it doesn't have the borrowing. So there's not that concern about the knock-on effect.
To banks.
Secondly, it's in coal, and we know coal's struggling. But thirdly, Chapter 11 in the US is not as negative as bankruptcy or liquidation here in Australia.
Yeah. It sounds positively good, doesn't it? Well, I'm in Chapter 11, so start off.
Well, that's basically it. It guarantees a lot of protections.
But your Arian will love this at Chapter 11.
Oh, they would. Exactly. It'd suit them. Atlas Iron would have loved a Chapter 11 protection because creditors can't move on them. They get time, they get space to renegotiate their deals and work out if they have got a viable business. To me, that's a sensible approach. And plenty of US companies have gone into Chapter 11 and come out multiple times. The airlines come to mind. But it's a protection as much as it is for investors as it is for the operations of the company. And that's why we haven't seen an adverse reaction. All of their coal mines are still operating. It's business as usual on the ground. It's just whether or not the structure that it's currently housed in will remain the same. Okay,
BHP and Rio, the share price have done really well this week. Are we likely to wake up next week and bang, down we go again to $16 something for BHP?
We can never rule anything out, Peter, and especially there's potential for disappointment around this Doha oil meeting with OPEC and Russia and the others, and that could knock commodities down, and that would take a bit of the gloss off.
This might surprise you, but I'm really optimistic that something good will come out of Doha, but that would surprise you.
I'm not, but I think it's only a short-term blip. I think the real reason to buy oil is because US production has fallen back below 9 million barrels a day. That's a clear supply-side response. That's what we've been looking for. So whether it's Doha or whether it's US, it doesn't matter. Oil is looking a lot better. So are all the commodities. And BHP and Rio have got a long way to go still on the upside before they get to what I think would be a reflection of current commodity prices. At the moment, they're still being discounted for potential commodity price falls.
Yeah, OK. All right, so this moves to the interesting story of this week, and that was milk, China, Bellamy's, Blackmores. Are these companies still a buy at these levels? Like Bellamy's, I think, is $10.04 today. Its high in recent months was $16.50.
Well, let's be clear.
Still a buy?
Yes.
Yes.
Because what China said was, we don't like this distribution channel. They didn't say we don't like you or your product. They said we don't like you doing it this way. You can bring it in this way or that way. There are three ways in.
With a tax, but the tax is...
We're talking 8 to 11%. It's not a game changer because what drives so much interest in Australian product in China is the perception of our purity, our quarantine status, and that the foods we produce are particularly pure. That's not going to be changed by a 10% tax. And so, you know, we saw the CEO of Blackmores out on the stump. Perhaps could have put the message a little differently, but pointing out long term, this makes no difference to the story. So yes, this is the rare opportunity you get in a highly sought after stock to buy it at much cheaper prices than we've seen for some time.
But Macca, it was $3 a year ago and it's $10 now. Was it because when it was $3 people just didn't get the potential of this market?
Well, there were operational risks too. They had to get their plants up to speed. They had to make things work. They had to demonstrate that they could make the contacts in China and sell on the ground. So there was a lot that had to be done. They've proven a lot of that.
Okay, well, you know, I'm not the person to be a naysayer, but its PE is 51. How do you explain the way to someone who says, well, that seems like a pretty big PE?
Well, the answer to that is, what's their long-term growth prospects? If they've got long-term growth prospects of 25%, that's a PE to growth ratio of 2. And in this sort of sector, That's perfectly acceptable in my book. So it's not just
It's a bit
about
like Ramsay 5 years ago. We wouldn't buy Ramsay because the PE was too high, and look what it's done.
I wouldn't buy CSL at $30, Peter, because the PE was too high. It went to 108.
I've made those kind of mistakes as well. That's a good point. So, and I guess this is the bottom line. Your biggest gamble is that will China change the regulations? Probably won't. Will other companies come and try and take, spoil a picnic? But these businesses become takeover targets as well, don't they?
This is one of the key themes for the globe, that the rising consumer demand in China, and these companies are feeding directly into it. Yeah. That's why they've got such good growth prospects. It's why they're so sought, and it's why they are potential takeover targets.
I wrote this many years ago, well, probably 2 or 3 years ago, and it was a bit of a play on words, but maybe it's actually probably right, that when the mining boom could easily give way to a dining boom. It's been forgotten, hasn't it? But when you think about it, we are a great agricultural nation. We're a great mining nation. We're a great agricultural nation. And as China, transitions to a more service economy, incomes go up, a lot of our businesses in this space and other agricultural spaces are going to do well. Very likely. Tourism's another very likely area of ongoing support from this rising middle class. But yeah, food is, for us, a no-brainer. All those tough quarantine laws and the tariff barriers we had over the last 100 years have finally paid off. Remember there's a surprise when we came back from overseas. We're sitting there and we instantly copped those chemicals.
Yeah, whatever that was.
Yes, well, they kept the bugs out and probably we're still living anyway. So I guess my question to you now, as we're running out of time, is there a company out there that you think looks like good value? Some of the defensive stocks are being clobbered this week.
Well, that's what, I've got a bit of a contrarian bent, and I like to buy when things are down. Yeah. But there's one going on at the moment. Now, your regular viewers would know I'm not a fan of the property trust sector. I invest directly in property. I generally don't use the listed vehicles. Okay. But there's a big game on at the moment. Okay. Dexus is making a bid for Investor. If they get it together, it'll be the biggest.
Investor is
IOF.
IOF is a ticker code, and it's a property REIT. It's a REIT as well.
It's a REIT. They're both office REITs, and if they bang this together, it'll be a $24 billion portfolio of office property. So pretty Australia's biggest.
Is it going to involve debt?
The gearing levels at the moment, I believe, are between 25 and 30% for each entity.
That was part of the problem with the REITs in the during the GFC. They were carrying too much debt, weren't they?
Yeah. Now this proposed deal has a scrip component, so that takes out a lot of those concerns. Okay. So overall, no major increase in debt.
You're the third player in this game.
Well, this is what I found out on Monday. Pete Cromwell out of Brisbane, CMW is the ticker, have taken a 9.8% stake, and they paid a premium to the takeover bid. The bid is at 418. They paid 427.
Why would they do that?
They see a strategic foothold here, Peter.
And so Cromwell plus IOF would also have economies, just the same way as Dexus did, but IOF is nowhere as big as Cromwell's nowhere as big as Dexus.
But this is very final. But I don't think that's the answer. I suspect there might be an attempt to merge all three, because the Brisbane properties that Cromwell have are very interesting in the context of the other two. Okay. So I suspect they might be trying to deal themselves into the table and get reverse taken over.
So my viewers will be saying, well, Mako, which one do we buy? Dexus, IOF or Cromwell?
There's never any harm in holding the target, IOF. I think Dexus would do well if they get the deal across the board, and I think eventually there will be, but I think Cromwell are going to nibble away at it, and I suspect they'll be the big winner.
Has its share price spiked today, Cromwell?
No, it's sitting around 99.5 cents. In fact, it was subject to a number of downgrades.
Courageous decision, Mr. McCarthy. But it's an interesting...
Watch the price. Yeah. That's all I'd say. Watch the price.
OK, we'll do. Interesting one. Have a great weekend, Mac.
Thank you.
Thanks for coming on the show. It's been a great comeback for the stock market, as we said. But let's have a look at, basically, we're all worried about our retirement, and after the break, we'll be talking to Melissa Howes of BT about what we're thinking about superannuation and our retirement.